following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC Team, Mike, Al, and Mark, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC Team, Mike, Al, and Mark.
And we're going to be talking about money because it is Saturday and we are talking about money. That's the name of the program. There's a new craze, or maybe it's not new. Maybe it's just a craze. Maybe it's just happening. Sports betting and betting worldwide has suddenly taken off. Sports betting in 2024 will reach $150 billion. Just 6 years earlier, it was just $7 billion. And online casinos will take in $80 billion in 2024, and they're off and rolling. It's something which we're seeing a lot of well-off young men doing sports betting. Men with 40% of them have incomes of over $100,000. And the fact is that 40% of all Americans are now betting on sports. It's now legal in 38 states. It wasn't very long ago. In 2018, it was only legal in Nevada, but now 38 states. And my guess is that most states will make it legal before it's all gone. It's been a loosening of prohibitions. It's been a question of governments searching for new revenues. It started maybe with lotteries, but it's extended to casinos. It's extended to online gambling and technology. In the U.S., it's expected in 2025 to be a $700 billion industry, and it's growing worldwide. And that doesn't even take into account things like day trading, which is a form of gambling, in my opinion, as well. That's expected to be $2 trillion. But before we get going much further, I want to introduce our guest today, Steve Poirier. He is, by his definition, becoming a professional poker player. But before we get to that, Steve, welcome to the program.
Well, thanks for having me.
Why don't we get your background? Tell us about your background.
Yeah, sure. My pleasure. So again, my name is Steve Poirier. My background's taken me in a lot of directions. So I graduated from college back at Florida State University back in the late 2000s. And relatively quickly after that, I ended up going overseas, taught abroad in South Korea. And while I was over there, I had the pleasure, maybe we'll figure that out after the fact. I had the pleasure of really falling in love with poker in a deeper way. It took me to some really interesting places. I've met some very interesting people in my poker life. We can get into that later, maybe. And after that, I returned to America. Probably struggled a little bit with China transitioning back to a different culture, but fell into sales. While I was in sales, that led me down the path eventually of financial advisory. And that's kind of where I started to fall in love with a little bit more of the human psychology element. While I was doing that, I definitely focused more on that full time, but life changes happen, and I think I'm back in poker pretty aggressively now, and really enjoying the psychological dive that I'm finding in it.
So let's talk a little bit about the difference between professional poker and recreational poker.
Absolutely. Let's
talk about tournament play and cash games. First of all, explain the difference to us.
Sure, my pleasure. And again, depending on the day of the week and who you ask, these answers can change wildly. But at the highest level, I would say that tournament poker is going to be a lot more akin to things like you might see in high levels of chess. There are, of course, going to be the folks who like to play tournaments on the recreational side, meaning that they're there maybe for fun. There's a tournament while they're in town in Vegas, whatever it might be. But when you start to get into the slightly higher levels of play, you begin to really see the seriousness that people are taking the tournament side that you don't typically find on the cash side. One of the big reasons why there's such a large divide is when you play a tournament, essentially anybody that can buy in can enter. There isn't really any gatekeeping involved. But when you start getting into cash game play, especially as you move up the stakes being how much are you playing for, suddenly you'll start being introduced or maybe not introduced to the gatekeeping aspect where certain types of play is allowed, certain types of players are allowed, while others will be excluded. So there's a lot more politics, you could maybe argue, found on the cash side than you do in tournaments. The differences really don't stop there. I think mathematics and understanding variance in a much more scientific way is overwhelmingly more important and emphasized in tournaments than you find in cash as well.
So I'm a recreational poker player. That involves two aspects. One is the friends game where people play, and the friends game I play in is pretty competitive, but also at the fortune or the poker rooms where you play no limit hold'em, or there's other games you can play too, I think. 7-card stud you can play. And what's the one where you get 4 cards? Omaha. Okay.
Omaha is essentially, just to give you an analogy to the stock market, Omaha is kind of like when you get introduced to derivatives trading, when you are just, buying equity beforehand.
Okay.
It's definitely for the folks that are looking for a little bit more sizzle in their game.
It's a fun gamble game.
So, as you can tell, I play no limit hold'em. I go with a very limited amount of money, and if I lose that, I'm done. I consider it just a recreational thing and enjoyable, like going to the theater, going to the Mariners, going to the Seahawks. It's money. Sometimes I win, sometimes I lose. But it's recreational. I do it 3 or 4 times a year, so it's not a weekend kind of thing, but it's recreational. And I would guess that most of our listeners, if they're involved at all, are recreational rather than professionals.
Absolutely. I think that just the concept of what it means to be a professional poker player, listeners should understand that this is kind of a quote industry where being a professional poker player does not always mean that your income source at any given point is solely based on that thing. So I think I could pretty confidently say that the term professional is a little bit more loosely used in this career than you might find elsewhere. And you'll see that that's true really no matter how much you scale up. There is, especially on the tournament side, there has become a much stronger emphasis on your ability to generate content around your game, whether that's social media, whatever it might be. And that's being done as a way to also mitigate the variance of play. So while in perhaps other professional endeavors, the craft itself in its purest form might be enough, poker's a bit unique in its variance, and just the fact that you can be on the wrong side of variance for a long time, where it requires you to wear multiple hats. So for some, that's a second job. For others, that's an amazing social media presence. And for others, that's staking, which is going to definitely have some similarities to what takes place in money management.
So talk about staking.
Sure. So staking is really kind of why you've seen poker tournaments, by and large, continue to increase the buy-in amounts. Staking is a way for players that take the game more seriously to get financial backing, to minimize their variance, and to also essentially lock in more playability. I was having a conversation with you beforehand talking about situations where you're just on the unfortunate end of luck, the pocket kings versus pocket aces for people that know it. And unfortunately, sometimes you just have to lose. The only way that you can really make up for that is to just get yourself in that situation more often, because you won't lose it all the time. That's an example where staking can really benefit you. It can be very, very hard on your mindset and on your wallet if you are essentially paying for everything yourself. So staking, much like you might see with maybe money management, to use a loose analogy, when you're a money manager, it allows you to use essentially others' money to place positions in the market, oftentimes much larger than you could by yourself. So it provides a way for you to give others access to your skill, but it also provides a way for you to get access to more profit, because what you really need when you're good is just more opportunities to show that you're good.
Is that similar to like corporate sponsorship? Would that be a form of staking as well?
Maybe. I think that sponsorships usually are going to come with a lot more restrictions, right? Now, if you're talking about really higher value staking relationships, so let's move into the world of the, maybe the $10,000 buy-in plus tournament. Those types of tournaments, you are oftentimes going to have certain kind of rules, requirements, structures that you are not allowed to play in versus are allowed to play in. Again, we're talking about folks that clearly have an aptitude for taking on risk, maybe more than they should. So sometimes you'll rely on your stakers to keep you in check as well.
Yeah.
Okay.
So stakers, if I'm a professional poker player and I get staked, so someone puts up half the money, I put up half the money. Do they get half the winnings?
Yeah, it's a good question. So, and just an example for anybody out there that might want to see what this looks like. A website that is kind of well known for doing this is pokerstake.com. If I'm not sponsored by them in any way, shape, or form, I just thought it would be a good example to show.
Disclosure's key.
Yeah, it depends on how good you are. There are players that have a bit of a proven track record where they will charge a slight markup for the action that you buy. That markup is usually very small, but in the past, when staking was a relatively new endeavor, the biggest names in the game would absolutely exploit that. So Phil Hellmuth would be charging you 2-to-1 if you wanted to buy a portion of his action. Typically, you're gonna do about 1.1 to 1. So the markups are very, very tight and very small now. But yes, so essentially it might be dollar for dollar. That you can always find people willing to sell it like that.
Interesting. We're going to come back after the commercial break, because we are commercial break, and talk about poker playing. We're going to talk about gambling. This is something that has really taken off worldwide. And if you're an investor, you have to understand this industry is.
About Money with your AFC team, Mike, Al, and Mark on AM 1300. The Answer. For more information, click on adamsfinancialconcepts.com.
Welcome back. We've been talking about poker, but in this whole realm, I often talk about three games: chess, slot machines, and poker. In chess, experts always beat novices. I use an example. One of my favorite examples is my grandson, who is 23 years old and who is a very good chess player, probably rates around 1,700. Masters rate around 2,500. Beginners around 600 or 700, maybe 400. Anyway, he's a pretty good chess player. He played the #1 chess master in Seattle at just a pickup game in one of the, at Linda's Tavern, actually, where they have once a week chess meetings. Anyway, and he lost. And after the game, he asked the master, what did I do wrong? And the master said, you didn't do anything wrong. I just outplayed you. Plain and simple. Then he played the master's 6-year-old daughter. She beat him too. So part of it is intelligence. Part of it is skill. So with chess, experts always beat novices. With slot machines, experts have the same luck as do novices. No difference. But with poker, there's a difference. Novices sometimes beat experts. It all depends upon how long they play. Right, Steve?
Yeah, absolutely. I you worded that very well. The thing that makes poker appealing is the fact that it has that any given day element to it, right? You can show up in a tournament, you can show up to go play cash on a Friday night, and anybody can technically win in that one session or that one tournament. Absolutely.
That's what happened the first time I went to play recreational. I didn't understand position. I didn't understand, who had an advantage, what the advantage was of being down to the left side of it. Anyway, I didn't understand any of that. Didn't understand the hijack, the low jack, the cutoff, any of that. None of that I understood. But I won the first time. And so I came away thinking, I'm really good.
It is kind of funny.
I got creamed the second time.
And over time, does the variance reduce, kind of smooth out reversion, kind of to the mean of how you play?
Well, so yes, and I know what you mean, and the answer is yes. It's more kind of like, it's not that the variance decreases. It's just that you see all sides of the variance. So, if you're in a situation where you're going to win 75% of the time, you just have to remember that 25% of the time you're going to feel really bad. And you might lose that 25 times the first 25 times you see the situation. It really won't work out like that, fortunately. But hey, maybe once in a blue moon, you're just the really unlucky bad luck Brian of the table. But yes, so it's more just about, are you getting enough opportunities in said situation to see the variance take shape the way that it mathematically should? And again, that can take an incredibly long time. Some folks, they are very fortunate and they happen to be on the positive side of variance early in their careers. There's just no way of knowing where you're going to fall.
I think one thing that happens is a lot of people see patterns where patterns don't exist.
Absolutely.
There was an experiment that was done and repeated a number of times where the people that were participating in the experiment could not see the coin that was flipped, but they were told, I flipped the coin, it came down heads. What do you think it's going to come down next time? Flip the coin, it came down heads. What do you think it's going to come down next time? Flip the coin, heads. Third time in a row. For 6 times, repeated, it came down heads every single time. They ask him, what do you think it's going to come down with flipping the coin? What do you think it's going to be?
My background in Baccarat tells me it's going to continue the trend. No, I'm kidding. Yes.
I mean, 80% will predict heads, when in fact, having not seen, of course, they were just telling people it was heads, but people pick up patterns. People look at stock charts and see patterns. They see the cups and handles. They see the gap. They see all sorts of things.
Heads and shoulders.
Head and shoulders. And they use that to predict what's going to go on. John Train wrote a book called The Money Masters, and he offered $10,000. Of course, the book goes back to the 1980s. He offered $10,000 to anyone who could correctly predict what the rest of a chart was going to be. He would take the first half of the chart, give it to somebody. If you could show what the last half of that chart was going to be, $10,000. You didn't have to put in any money. It was automatically. You could just make $10,000 by predicting the last half of that chart. Do you think anybody was able to do that?
I could make some jokes about Citadel and Ken Griffin figuring out a way, but I'll save those for another time. But no, I'm sure everybody failed at it.
I don't think Buffett's lost his $1 million bet for a perfect bracket either. So, yeah, it's tough to predict those types of things.
No, he's never paid anyone $10,000, no matter how many people have tried.
Does he provide the ticker for the first half?
No. He just gives you one half of the chart. You predict the second half. So we live in a very dynamic world. Financial planning is based on a static world. A lot of looking at head and shoulders and looking at these different charts depends upon a repetition. If it was really about predicting the future, the people with the largest computers would always win. There's a reason that people that are running algorithms don't beat the market. To me, that's always a surprise.
I think one of the interesting kind of lessons I've picked up over the past year was there's a phrase that's used in poker that I'm sure you guys have heard when you say that you're running good or when you're running bad. And it was understanding that there's a truth behind the statement. When I hear it when I kind of take the phrase at face value, I'm like, okay, this sounds like armchair quarterbacking. This kind of sounds like you're seeing what you want to see, right? How can you run good in a game that's based on math and whatever? There's no such thing as luck, ultimately, is what I'm saying.
Yeah.
And what I've come to learn is that when you say things like running good to players that are trying to take their game to another level, it probably has some similarities with your industries. When a player is running good, what that means is they are able to essentially recognize the situations where their equity is favorable to them. And in those situations, they are capitalizing by making the appropriate plays to realize that equity. And when I say equity in the game of poker, what I mean is your opponent's chips going into the pot when they have a worse chance than you at winning them. So when you are running good, it essentially means that you are making good decisions. Your psychology is aligning with the game, with the math. And you're essentially, quote, firing on all cylinders. So it is very interesting how luck stops even really being a word that's used once you start moving into the conversations with folks that are taking it more seriously, which I would assume it probably has some similarities to when you talk to an amateur investor, a recreational investor that puts $4,000 in an E-Trade or a Robinhood account, or somebody that has a long-term strategy towards their holding an Apple. It really just it depends on the seriousness of the mind behind the question.
You're kind of discussing risk management too with your equity there, right? Because in card games, right? Like if I go play for fun, I got a 2% chance to hit this flush draw, but I play once every quarter. I might just go for it, right? And over time, I'm going to lose 98 of those.
Yeah.
But as a professional, right, if there's enough money in the pot, right, which would be the kind of risk management, right, like, well, what are the pot odds here? You may actually play that too, more often than not based off of the size of the pot. Is that what you're kind of getting at?
Yeah, to an extent. And I would almost say when you're in that kind of situation, that's like fun management more than risk management, right? Because there's nothing to manage from the risk standpoint. You're essentially just hoping it goes well for you. And that's fine too. Those are, as funny as it sounds, those situations, especially when you're on the cash side than the tournament side, has a lot of added value that goes without being discussed. There is something about your image that generates a lot of return on a cash game that you really don't get the opportunity for in a tournament, just because the structure of the thing itself. So yeah, but risk management is definitely a part of poker, especially when you start getting near the money when you're playing a tournament, because in those situations you are absolutely focused more on the risk of losing than you are on the opportunity to capitalize.
Explain that.
Yeah, sure, no problem. So picture yourself in a tournament where there are 200 people away from making the money. Essentially, when you're that far away from making the money, whatever's going on in a given hand doesn't have a lot of significance. If you're right on this decision or wrong on this decision, you're still 200 players away from it putting money in your pocket. When you're in a tournament where there's now only 5 people away, every decision becomes exponentially more important. One wrong move and the 12 hours that you've put into this thing turns into $0. So essentially what you see in a tournament, as you get closer to the promised land of making money, players typically become overwhelmingly more conservative, and every decision's importance is extremely amplified. So again, that probably has some similarities with options trading, but I'll leave that up to the experts to describe. I don't want to get my Greek definitions wrong.
It has some interesting connotations with a lot of people when they're investing in stock, especially in the olden days. When I grew up with investors, where you were doing transaction business and recommending stocks to investors. And some, when they had a stock that was down and it had been down for a ways and it starts to get back, they'd say, when I get up to break even, I want to sell. And my thought was always, that stock has no idea of what break even is for you. It has no meaning. Either you're in the stock because you think it's going to go up, or you're in get out of the stock because it's going to go down. Anyway, don't go away. We'll be returning to this.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike, Al, and Mark.
So, you're probably familiar. If you're in Seattle, you probably know the most famous football play in Seattle Seahawks history. Taking the example from Annie Duke's book, I actually agreed with her at the time. And you know it. It was the Super Bowl 49, 2015. Seattle's second straight time in the Super Bowl. They were playing against the New England Patriots. The score's New England 28, Seattle 24. Seattle's on the 1-yard line. 26 seconds to go in the game. On the 1-yard line, trailing by 4, score a touchdown, you win. Straight it. Kick a field goal, you lose. You've got to score a touchdown. It's the second down. Everyone is expecting Pete Carroll to call for a handoff to Marshawn Lynch. Lynch was the beast. He carried the ball again and again. Everybody thought that was the play. One of the best running backs in football. But instead of handing the ball to Lynch, Pete Carroll calls for a pass play. Russell Wilson passes. Malcolm Butler, an undrafted rookie playing a hunch, steps in front of the intended receiver, intercepts the football, the game's over, the Seahawks lose. It becomes one of the most famous plays of the Super Bowl, if not in football history. USA states, what on earth was Seattle thinking with the worst play in NFL history? The Washington play said, the worst play call in Super Bowl history. It'll forever be the perception of the Seahawks Patriots. Fox Sports says it was the dumbest call in Super Bowl history. Could be the beginning of the end of the Seattle Seahawks. Seattle Times said the Seahawks lost because of the worst call in Super Bowl history. New Yorker said a coach's terrible Super Bowl mistake. But was it really? Was it really? I watched. I thought we were going to win. I was deflated. 60 times during that season, that play was made from the 1-yard line 60 times. 60 times. Not once or twice. 60 times every time it was made without an interception. The only time there was an interception was in the Super Bowl. In the previous 15 seasons, it was done 538 times with a 1 in 50 chance of being correct. There were 3 things that went wrong. Three things could have happened. It could have been caught. It would have been a touchdown. Game over. Seahawks win. Second, it could have gone incomplete. There would have been 20 seconds left in the game to try a third down and give it to Lynch once or twice more. But the the Patriots were expecting Lynch to carry the ball, and they were stacked to stop him. Why were the headlines and stories so brutal? Pretty simple, because the play just didn't work. Biggest play in Super Bowl history, and it didn't work. Had it worked, Pete Carroll would have been called a genius. I think when you look at it in terms of skill and luck, there is some luck. There's some skill involved. And we've been talking about poker and gambling. I think it's the same kind of thing there and in picking stocks as well. I think sometimes you can throw the interception from the 1-yard line on the second down with 26 seconds to go.
Well, I think you'd probably agree that, the skill is in your ability to try to reduce those luck factors. The skill is in mitigating the elements that can essentially expose you to more variance. And your example's very funny, in part because I would argue the dumbest play you could make is the one that everybody saw coming.
Yeah.
And clearly it was not passing on the 1-yard line. There are plenty of Seahawks fans that would also argue that it happened because Malcolm Butler got there before the ball did, which I heard plenty of. By the way, my family is all from Springfield, Massachusetts. They are all New England Patriots fans, and I might have been at a bar in downtown Seattle with a group of Patriots fans screaming when that play happened. It was like a Christmas miracle. But yeah, we did not think it was the dumbest play ever, just so you know. We thought it was a little known fact about Pete Carroll from his assistant coaching days. He promised to bring a ring to New England while he was an assistant coach, and I would just like to say shout out to Pete for delivering on that promise.
That's good.
So I just got to get that little jab in there. It's been almost 10 years. I got it out.
And even if it was a touchdown, TB12 would have had 20 seconds left?
Yeah.
Yeah, he's scoring 3 times.
He's seen enough of those decades, yeah.
Yeah, that Falcons game. That said
sometimes we look at that. Sometimes we look at accounts being down and think, things have gone wrong. Very often in investing, you're going to be behind, just as in poker. Sometimes you have pocket aces and somebody has pocket deuces and they win because, the flop comes and nobody's helped. The river comes and nobody helped. Or the turn comes and nobody's helped. Or the river comes a deuce and you lose. Pocket aces, you lose.
Yeah, it's very interesting when, if any of the listeners have, a bit of a curiosity around poker, is, you can go onto YouTube and watch old World Series of Poker tournaments and see how the game has changed. You can see how all of these steps have taken place to minimize the variance to benefit the skill players. One of the biggest ways that you see that would be in bet sizing, which again is going to sound probably very similar to investing. Just for a little bit of background, if you were to go back to the origins of the poker boom, which was Chris Moneymaker in 2003.
Yes.
A, his last name was Moneymaker. B, he was an accountant from Tennessee and he got there on a $100 satellite.
And he was funny.
Yes. And to make the final table, he beat the best player in the world at that time, Phil Ivey, by getting lucky on the river on camera.
Yeah.
So everything lined up for the poker boom to work the way it did. But if you look at the way the game was played then, your average bet size, if you were going to raise before you saw the flop, back then was about 4 times whatever the blind was. So let's say the blind was 200 as a chip amount. The standard raise you would see pre-flop might be to 700 or 800. It's a very, very large bet. That's arguably a psychotically large bet by today's standard. If you see the game as it's played today, your average bet pre-flop, your raise, is 2 times the blind. The reason why they do that is if you're exposing less of your stack to the risk of variance, you have more preserved for when you know you have a stronger lock on the situation. So that is an example of, and there's so many ways that the game has done that. You know, you had mentioned Omaha. Omaha is a game where you start with 4 cards instead of 2, which just turns everybody into having a potential shot at winning, right? In Omaha, you're very seldom worse than 40% to win pre-flop, no matter what 4 cards you have.
Yeah.
It is that kind of game. So what you typically hear from players is this is a, quote, post-flop game, meaning you don't typically get very squirrely and aggressive before you've seen the flop to start to understand how your hand structures with it. We're starting to see no limit hold'em move in the same direction. So again, when you start thinking about the market, I would assume with, you know, making position sizes, etc. I know there's a lot of focus on how much of your investment is in X and how much of your investment is in Y. If your percentages get too high, it can be very hard to mitigate downside risk, just because there's so many unknown factors. The market is not operating on perfect information for the normal person, much like poker.
Yeah.
Interesting, yeah.
And I think that really applies. $2 trillion done on day trading. It's huge. And the very, very few day traders ever make it long term. We had friends who he was a day trader, and during his day trading days, he made a lot of money and then lost the house. Made a lot of money, bought a new house. Once again, lost the house, lost his marriage, lost whatever. But it became it was almost an addiction for day trading. It's that feeling that just a little more and you're going to be there.
Well, hey, you're only one parlay away from breaking even.
Very
you
true.
know, that's what they tell me.
That's what they all say on the videos, right? Keep going until you hit it.
Yeah.
Well, I think in roulette they have that one. What is it? The strategy, the martingale, where you essentially put down $1 on a black. It doesn't matter. If you lose, you put down 2. If you lose, you put down 4. And as long as your bankroll is infinite, eventually the casino will still take all your money.
Yeah.
But yeah.
Well, the casino can outlast you, you know, all the way up.
That's a dangerous way. It's of thinking the martingale strategy of just doubling. And we've all gone out there with money and maybe done it once or twice, tried to see if it paid for the night out casino or whatever. But it's very dangerous when you start getting to bigger stakes or investment management.
And it's, you know, all of this we're talking about is short-term play.
Mm-hmm.
Short-term play, the odds are stacked against you. Whether it's in day trading, whether it's in gambling at Las Vegas. Gambling at Las Vegas is not really gambling. The odds are always in favor of the house. So
yeah, and in poker, you know, much like you have in the options market, when you buy an options contract, some of your money disappears right away in the form of premium. When you're playing a cash game, money is disappearing every single hand in the form of what's called rake. So you are always in a process of slowly losing, which puts the pressure on people to play. But yes, it is always a losing endeavor unless you take agency and try to change that. But that's the risk.
Or unless you play against worse players. Pick a table where their players are worse.
Absolutely. You know, game selection, especially on the cash side, is, I think we had talked about that before, how, you know, probably the most important skill in really leveling up your game in cash game poker is not found in a book. It's found in game selection. It's found in the patience to know that this game is not going to reward the way I play, but another game might.
And it is found in books. Alan Schoonmaker wrote books on how to win at poker, not by the hands, but by picking the right people to play against. We'll be right back after this commercial break. Don't go away. More to come.
About Money with the AFC team, Mike, Al, and Mark on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So as we finish up, poker is a game of odds, right?
Yes.
It's understanding that if you have pocket aces and someone has pocket jacks, your chances of winning are 80%, right?
Yes,
Am I wrong?
That is correct. Might be 82 because they have some straight draws covered, but yes,
Okay.
82.
So having aces, pocket aces is always better than having pocket jacks, but pocket jacks will win 20% of the time. And understanding the odds, understanding as the cards come down, and I like to use a 5-card straight because you get one card down, one card up, and then the next card comes, and you can have an ace showing and an ace in the hole. And if aces come up on 2 other players, you know that your odds of getting a third ace are 0, and someone probably has a better chance to win, right?
Absolutely.
Stock picking can be a similar type of thing. It's a matter of lining up the probabilities of a win versus the probabilities of losing, and looking at it in a long-term aspect. If you're looking at a company which is growing very slowly, the chances are the stock price is going to continue to grow very slowly. If you're looking at a company that has an industry which is huge and they're small and they can take market share, your chances of winning are much higher. It's all a game of probabilities. It's all a game of understanding. It's a game is probably the wrong word to use, but to succeed, it's a matter of lining up the probabilities, knowing that there's luck and skill. And the skill is picking the probabilities of winning, knowing that sometimes things are going to happen that are going to push the stock price down. Sometimes you're going to have a pandemic. Sometimes you're going to have a great recession. Sometimes you're going to have inflation. Understanding how that affects your stock picks makes a huge difference as well. Understanding as we think that we're headed for a time of very high inflation, a time of inflation like we saw in the 70s. If that's true, it means that changes the odds for a company today that looks like it's going to be a strong company with no inflation. That's going to change the odds for that company compared to a company that's going to do better with inflation. So you have to line your portfolio up with the expectation of where things are going. When you're sitting with pocket aces or pocket jacks, take the example of pocket jacks rather than pocket aces. You're hoping in that hand, not seeing anybody else's, you're hoping that the flop comes with 1 or 2 more jacks, right?
Yes.
And
It's-
not 8-8 king.
And it's really funny too. One of the similarities that drives me crazy between investing and poker is the concept of past performance not indicating future returns. And there are so many examples where you will watch a player at a table just decimate other players at the table every time they're behind in the odds. But for whatever reason, every time they get into it, they just seem to get lucky. And what's very funny, when you see that enough, you'll find yourself in the situation against that opponent where you are absolutely confident you're ahead. But man, you can't shake that past performance. And that past performance will lead to you making bad choices when you arguably know what you should do, which reminds me of Meta when Meta went into the 70s. And I sat there and was terrified. But that's a whole other story.
So I think having to say past performance is no guarantee of future performance is absolutely 100% correct. No question. But if you read what's the best predictor of future performance?
Past performance.
Past performance. If you can say that Buffett, who was probably the greatest investor of our age, you can say past performance is no guarantee. The fact that he's achieved the returns he's achieved, you cannot guarantee that will continue in the future. For one thing, he'll probably die before too long. But anyway, that's another.
Well, it's past performance, right?
But going back to the 1999 time period, 2000 time period, when Buffett was down and people said, well, I guess this shows that his time has passed. They were so dead wrong because his past performance. But the big brokerage firms, the ones that I grew up in, always had this mantra, sell the relationship and not the performance. Make people like you. If you have terrible performance, don't worry about it. Make people like you. That's the important thing. And if you look at their returns, 5% return is the average for financial advisors. 5% makes it possible you don't get sued, right? Because you're not losing money for people.
It's very true.
And the big firms have to love the idea that past performance is no guarantee of future performance, because now you take away the incentive for investors to look at performance and to make decisions on performance. Now it's just, are you going to achieve your financial goals? It's not about, we could have a recession coming up. We could have a depression coming up. We could have a high inflation. We could have a pandemic. We could have an asteroid that hits the Earth that causes problems. We could have a terrorist attack where they drop a nuclear bomb on Los Angeles.
We've got drones over Oregon, New Jersey. I don't know what's going on with these drones, but yeah, maybe.
It's all about sticking to your strategy, right? So a lot of the variables that are brought up there, a lot of the black swan events, we can't predict those. You can't build those into the model. You can't build those into a strategy when we sit down of what do you want when you retire, or what do you need to buy your next car, your next house, your kid's college, whatever that may be, to go to Vegas and go play poker with the high stakes table. All can be goals, right? But you got to ingrain in those goals. You've got to invest accordingly, and you got to tune out the noise, because the noise is what will get you off your strategy. Just like watching that chump at the table, 2% draw, and then you're up against him. Mm-hmm. Big pot comes up, and he's wrong. But if you stick to your strategy, 98 out of 100 times, right, that pot's yours.
Yeah, it's a very difficult but very important mindset shift also, to train your mind to get excited by the things you can control, which I know gets said all the time. But when you're playing poker, those moments are arguably never about where the pot is going at the end. Excuse me. It's more about understanding that, okay, on this street, meaning on the flop, I need to make a bet of this size to realize equity. And if that happens, I have succeeded right now. And now that moment is done, and now we move on to the next moment, and it never stops. It is an never-ending cycle of that over and over again, and it very seldom is about the pot.
Exact parallel to what we're doing.
It's exactly the same with the stock market. Yeah. It's never
always
always a changing time, and it's always looking for the equity you have and looking at the probability of success versus the risk of failure.
And in your scenario, you take all the different information from the dealer, the 8 other players at the table, or focus in on the one that you're playing against situation.
Well, you know what? I'm going to take this opportunity to just give a suggestion to the investment world out there, since we're making this comparison. Comping poker players is a great way to get them to go into the market. Maybe E-Trade needs to put up a hotel stay somewhere, and we'll all switch accounts over there. Just throwing that out there.
So our custodian is Interactive Brokers. They drove E-Trade out of business.
Maybe IBKR needs to. No, I'm kidding. Hi, Thomas Petterfee. How are you doing?
Anyway, thanks for being on the program, Steve.
Thank you so much.
It's been a fun time. I can't say that through this whole effort my poker game has improved, but, it's a recreational thing anyway.
That's right.
I'll probably continue to lose, win a few times, but have a good time. And that's what it's all about. Investing, on the other hand, is about making money. We have a passion for creating wealth at Adams Financial Concepts. You can always remember that. We have a passion to create wealth. And until next Saturday, have a good week. We'll be back next Saturday to talk about money.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today, or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.